a year of full volatility, rate fears, inflation headlines, geopolitical noise, markets ended up doing something few expected. They rewarded investors. By year-end, the market delivered over 17% in total return, led by communication services, technology, and industrials. What's even more striking in this, every single sector finished the year positive. Even real estate, one of the most rate-sensitive sectors, returned roughly 3%, which was enough to deliver positive real return after inflation. That's not what most investors felt in real time. The year felt unstable, pullbacks were sharp, sentiment shifted quickly, and confidence was fragile. But this is a perfect reminder that markets do not reward comfort, they reward patience. Volatility was the price of admission, and the diversification quietly did its job. Now, a major reason markets were able to push higher was inflation, not disappearing, but stabilizing. The Federal Reserve's preferred inflation gauge, the PCE, has been running around 2.8 year over year, with monthly readings averaging roughly about 0.2% in recent releases. That tells us inflation isn't re-accelerating, and just as importantly, it isn't forcing policymakers into more aggressive actions. For consumers and investors alike, that stability matters. But there's a nuance most headlines miss. During the federal government shutdown in the fall, key economic data collection was disrupted. Some inflation releases were delayed, others were partially estimated, and markets were forced sometimes to operate with incomplete information. That created what many economists call a data fog, where trends had to be inferred rather than clearly observed. Even so, the inflation data that did come through continued to point toward moderation rather than acceleration. So why did markets still perform so well then? Like we said, inflation stabilized. Earnings, very important, held up in key growth sectors, and leadership expanded beyond just a handful of stocks that led the market previously. This was not a narrow rally, it was a broad fundamental one, and that's why diversified investors were pretty rewarded. The takeaway is simple. Markets often feel most uncomfortable before they become most rewarding. Despite volatility, data uncertainty, and noisy headlines, disciplined investors were compensated, not just with nominal returns, but with real purchasing power gains. That's the common denominator. Stay invested, stay diverse, and don't confuse uncertainty with weakness. I'm Tammy Beck. I'll see you next time.